Are rates going to go up? Are they going to go down? We don't really know either. But in today's video, we're going to describe to you what we think is going to happen for the rest of 2024. Hey guys, Josh and Ehren from Build Financial back with another Finance Friday, and in today's video we are discussing what do we expect to see for the rest of 2024. It's been a wild ride. We've got a lot of ups and a lot of downs, and people are kind of trying to figure out just where the stability is happening in the market. We finally have some indication from the Bank of Canada that we're done with the rate hiking and we're going to start the rate dropping. We've already seen one CPI numbers, job numbers. All the data is coming out. We're kind of getting mixed motions. Did we cut too early? Did we not cut early enough? Thoughts?
Yeah, I think we're shooting this in mid-July right now. I believe tomorrow there's supposed to be the next inflationary data come out. I think they're expecting RBC forecasting from a 2.9 down to a 2.7. So looks like it should be trending downwards. Unemployment, is on the rise and has been rising, trending upwards. GDP, per capita is on the way down. So, when you take a look at these data points, everything is kind of leaning towards a drop in the CPI, which overall, from a rate standpoint, should start to offer more consistent relief on the rates moving forwards. Obviously, we're gonna have to kind of see how things continue to play out, but long-term perspective, the next 6 months towards the end of the year, heading into 2025, it does offer a stable outlook of rates moving downwards, trending downwards over the next year and a half for sure.
And I think the conversation with all of our investors is just echoing, like, now that there is some sort of certainty in the market, people are starting to make decisions again. The speculators are coming out in regards to flips. They're trying to figure out where the bottom is. There's a ton of inventory on the market at the moment right now, and really anything under 800,000 is still affordable. Above that, we're still not seeing anything moving in the residential space, according to some of the realtors we work with. So I think that affordability is still a concern, and probably will be for the next 12 months until we start to have some meaningful downward pressure on the overnight lending rate and those fixed rates. The spread between the bond markets right now doesn't always correlate to exactly where the overnight lending rate is going. The banks are still keeping their spread pretty high, not knowing exactly where things are going. So, they're not as willing to cut as fast on the fixed rates as the bonds start to move down. And Ehren and I track the bonds daily for the Canadian mortgage bond, and it seems to be a wild ride. It's very attached to investor sentiment more than anything. Tiff opens his mouth one day and says something, or Jerome Powell in the States decides that they're going to be a little bit more dovish or hawkish on their overnight lending rate predictions. And you start to have Bay Street start to change the way in which the stock is moving that day or the bond is moving that day. So bond rates and fixed rates in general are just kind of a mixed bag of emotion depending on where the investors are really focusing on.
Yeah, there's one thing that we've learned with the government. They raise rates fast, but they take their time on the cutting. For a few things, obviously you don't want to cut too soon. But, the banks are also about making their money, right? They're going to try to hang on to these higher interest rates for as long as they can to be able to just squeeze out as much margin as possible. So, even though we see these data points trending downwards, you got to remember they're lagging indicators. So it's not, we're not getting day-to-day numbers coming out and making the interest rate adjustments based off that. But you also, you want to make sure that you're actually making leeway forwards, right? You don't want to see once that numbers come out and then, okay, we're going to drop the rates 100% or 100 points and drop those down. And all of a sudden inflation is going to be back up and consumer spending will be back up. So, realistically for a proper long-term success in terms of coming into this environment, you want to kind of keep these rates as high and as stable of a downwards trend as possible without dropping them too fast and then just, inciting more inflation. And we're just back into a spiral and a big old loop. So, they got to be careful in terms of how they're going to drop the rates and do it strategically.
I completely agree. Where are things going moving forward? I think that from like an investor sentiment point of view, there are still great deals out there to be had. There's lots of people who have opportunistic capital who are sitting with dry powder on the sidelines who are picking up deals right now. Distressed properties, multifamily properties, a lot of mid and infill construction development. The bigger guys are shying away from any sort of like purpose built to sell. A lot of condo developers, guys who had these larger projects, you can't move them anymore. The debt just isn't there to be able to get a bank to come on board to allow you to sell these because you aren't getting any pre-sales. It's not working right now, which is kind of been a major shift that we've seen and probably continue to see over the next year. It's just like until the numbers start to make sense and the sentiment comes back into the market where people are going to buy these pre-built or pre-condo buildings, you're not going to see developers be incentivized to be able to continue to build to sell anymore, which is going to cause a huge issue later on down the road.
Yeah, I mean, it's tough data to analyze when you're a condo developer and you see unemployment on the rise, even though inflation's trending downwards, which is a good thing for the interest rates. As a condo developer, you want people to be able to have jobs and have income to be able to buy these units and put the deposits down. And we already have 60 probably to 70, maybe even 80 condo projects for stuff that hasn't been fully announced that are on hold right now in GTA, Greater Horseshoe area. So, I mean, I think that's going to just continue to increase in terms of projects not being put together for the condos. Purpose-built rentals for sure going to be coming back once, when you take a look at a purpose-built rental versus the criteria that a condo developer is taking a look at as a purpose-built rental builder, and somebody's going to be holding on to these projects, or at least to be able to sell these in projects to an investor, buying and building at the top of an interest rate market and understanding the relationship between the cap rate and what that's going to do to your value over a long term. If you can make these projects work right now, and same as buying multifamily, if you can get in and you can make these commercial type projects work at higher interest rates over the next 5, 7, 10 years, as these rates start to come back down and normalize, that value in that appreciation, which is really why you're getting these commercial projects anyways, right? It's not, cash flow is nice, but really we're taking a look at that huge appreciation. That's what you're really planning on right now and buying in today's environment is banking on these rates coming down and that appreciation going up.
That cap rate expand or compression is going to continue to happen. It's an inverse reaction to rates. It's just who has the capital to be able to take the bet right now. And a lot of the guys who have the capital are taking the bets right now, which is interesting to see as people start to play the cycle and where we start to see indicators as to where serious players start to get back into the market. Another major shift we see and we have been seeing is the shift in investor knowledge and the push to fundamentally understand how development and multifamily works. It's a little bit more required to be able to understand cap rates, net operating income, different types of capital, the process dealing with the city. We're finding that investors are needing to be more sophisticated when it comes to the actual investment side of things. It's becoming more difficult to be able to get capital. Residential real estate is becoming more challenging to purchase. So that level of sophistication from the average investor is being pushed to the limits here to allow them to succeed in today's market.
Yeah, especially on the development side, there's two things you have to have in development, and one of them is money and the other one is experience. And if you don't specifically have that experience yourself, you have to be able to have the capital to go out and buy that experience, or you bring the equity to a project to be able to bring that on, right? Like one way or another, you have to go and find someone that has the experience, either as a partner in the deal or as a builder or a contractor that's going to be able to take your development over. It's something that we're kind of seeing every single day, and we're having discussions with. And we've seen plenty of 20, 30, 40 unit deals come across our desk, but they're coming across our desk from someone that has built 2 or 3 townhomes. And that experience, even though you may have the money, doesn't translate or correlate over into building a mid-rise or a high-rise type building, especially if you're moving away from wood frame and getting into concrete type assets. It's just a completely different game. And if you're looking to get into CMHC on the construction financing specifically, one of the biggest factors they're going to take a look at is how much construction do you have? And they're really going to scrutinize that deal because that's your best type of financing. It's going to be your cheapest, your best structuring, and they're going to want the most amount of experience to be able to get that done. So, if you're looking to get into these projects, experience is going to be key. And that's where we're having conversations with a lot of our developers, mid-level guys specifically, about, hey, I know you want to be able to take advantage of this, 95% loan to cost type CMHC project, but your experience yourself, for a lot of these guys that are getting into it, it's not going to be there. Or taking a look at the loan size for some of this stuff. If you're under $5 million in your budget and loan size, it's going to be tough for you to get CMHC financing. There's not a lot of lenders out there right now that are taking on this financing. And some of the lenders that are taking on, we might lose those come September when we lose that broker correspondence. We're not really sure yet. It's still kind of up in the air, but again, there's not as many guys doing these under 5 million type loans, which is kind of where we're seeing the majority of the volume on these 8 to 12 unit kind of builds coming in. So again, finding a partner or finding a mentor who has successful development projects that can actually kind of teach you the ropes is going to be instrumental moving forward.
Yeah, without a doubt, that gap in the market, that pay-to-play situation in which somebody has to get the experience before they can get the financing. It's a chicken for the egg situation, and it always is, but it's never been more important than ever. As Ehren said, just echoing that, it's extremely important to be able to have to get somebody on your side to get the experience to do it. And in today's market where liquidity is a challenge and the majority of borrowers are stretching the limits to be able to get deals done, the more experience you have on your side, the more apt a lender is going to be able to give you that financing. And this is the trend we're seeing across the board with all just kind of mid-level financing options. Realistically, if you are somebody who has purchased a small multifamily or you own some pre-existing multifamily real estate, what we're seeing is multiple people coming together to be able to pool their resources, liquidity, and experience together to be able to create a stronger file. So if this is something you're interested in, it might make sense to find strategic partners to actually help you do this. We're finding that there are more groups of people who are looking to level up together instead of necessarily just trying to do this by yourself.
Yeah, and if you are in the space where you're looking at bringing on private investors, and there's nothing wrong with that, but make sure you have a conversation with us or with your broker in terms of understanding the timelines and what that takeout looks like, right? If you get into a construction project and you don't use CMHC to build, you need to keep in mind that on that exit, CMHC is still going to value your project from a loan to cost perspective and not from a loan to value perspective. So if you're expecting $3 million in equity from your budget to your as completed value, understand that CMHC is still going on that loan of cost, which means you're not going to be able to tap into all that equity. So when you're sitting down and you're running these projects with your investors and you're talking about, hey, I'm going to have a $3 million lift between our budget and the value, and we're going to get 95% of that back, understand that's not going to happen right away. So again, one of the biggest things you want to focus on is your relationship with your investors and ensuring that you can borrow from them long term. Make sure you understand the timelines and what that looks like and the structure and the takeout before you sit down and break out the ROI and the RI on your project.
And reiterating what Ehren just said, it's important to understand fundamentally how debt works within your project. One of the most important things about having a project, especially taking on investors, is understanding your debt and how you can transition from one piece of debt to another and how that's going to affect your equity takeout and capital back to you. There's too many times where we see too many pro formas with projects showing you an IRR or that lift, but having a broker who fundamentally understands debt structure and capital structure and how to put this together in a way in which it can help you overall at the end goal of your project is definitely the most important thing. One of the reasons why Ehren and I started Build was specifically to be able to give high-level institutional advising to mid-level investors and developers to allow them to be able to have access to all different types of capital and products. There's a gap in the market and we're happy to fill it. So, why we're giving you guys this information today is the same reason why we're doing what we do right now.
The last thing we want to kind of touch on in terms of trends moving forwards is going to be, what we see is the smaller shift away from CMHC financing for every single deal, your 5-plex, your 6-plex, your 8-plex, getting back towards a more normalized market is going to be more uninsured type financing. CMHC is a great product and it makes sense for projects right now, especially given the interest rate environment, but realistically, as these rates start to come back down, we're going to see a shift away from that on these smaller, sub $5 million deals. It's in today's market, CMHC has saved projects. It hasn't really been, it's not necessarily the best product for some of these smaller projects, but again, it's saved a lot of, but as these rates come back down and we can start to take advantage of those, I think we're going to start to see a shift moving away from that. Given these rates coming back down, it's going to make more sense when you start comparing the cost with the insurance premiums and what that does to your monthly payment versus taking a slightly lower loan to value and getting back into a more true cash flow type situation. I think that's where these smaller projects need to be, but also the flexibility you're going to have on your project. There's a lot of these projects where you've had to have a 10-year term on there to be able to make the debt structure work at a 1.2, which means you can't break that for 10 years. You have to, if you're going to sell it, they're going to have to assume the debt. A lot of the debts that you're taking on right now in terms of interest rates moving forwards aren't going to be probably very attractive in the next 5+ type years when we see these rates get a bit more normalized. So I think overall it is going to be a good thing. I think investors on this mid-level space going to have to kind of restructure how they're looking at their projects, because it doesn't make sense long term for you to be building out 10 units and then jamming it into MLI Select, trying to get 1.1 debt service, and kind of really diminishing that cash flow on there, because we are seeing some investors where starting to have some conversations with us, and it's like, oh, I didn't realize kind of how marginal my cash flow was going to be on this 1.1 debt service. Even though I got all my money out, hey, I'm riding, basically neutral or maybe dipping into some of the red on some of these months. So long term, I think it's good for the investors. I think it's going to force them to be able to, find a way to make their project a bit more viable without having to rely on these CMHC projects to really get it out.
Yeah, I mean, the good old days when commercial interest rates, worked, when we were underwriting deals at 3.6% and, the debt servicing was at 1.2, and there was still lots of room on the debt servicing to make projects work. So as rates start to come down and small commercial and commercial financing starts to come back to something that makes sense for an investor, those loans aren't always required to be on loan to cost. Those are loan to value. So there's advantages of being able to do this. And as Ehren said, the flexibility with it, it's going to be nice to see capital flow back into the normalized markets, into the credit unions and into regular standard commercial financing options. So as this happens, we're going to start seeing more small commercial, small mid-size multifamily projects in secondary markets start to make sense again. People start to purchase these as rates come down and opportunities show up. I think that's going to spur the ability for investors to purchase these mid-size multifamily properties in these secondary markets. All right, guys, so there's our crystal ball. There is our predictions for the rest of 2024 and beyond. If you guys did like this video today, please hit the subscribe button, hit the like button. If you have noticed, our YouTube channel for Build Financial is now live with all of our old videos. Hit the subscribe button if you like this. It allows us to do this for you every single week. We really appreciate you guys. Until next time, we'll see you around.